Hello, everybody, and thanks for making time to attend this webinar. Allow me to share my screen. And just to make sure that we are all where we're supposed to be, the webinar today is part of a series that SBS has been conducting titled Beyond the Pandemic. And we're going to be looking at the role of private equity and venture capital in spurring growth of the SME space in Africa. We're very fortunate to have David Owino, who's going to introduce himself in a bit once we get to that point of the program. Allow me just to do some quick introductory slides before we start with the webinar. So the program for today looks like this. We are going to be starting out by doing an introduction. The introduction I'm talking about for 5 minutes. Once we're done with that, we'll move on to the Q&A with David for 30 minutes. And then there's going to be an open Q&A forum where then the participants, yourselves, will get an opportunity to ask questions for 20 minutes. And then we'll have some closing remarks for the last 5 minutes. I would urge you as the conversation is going on, if you have any questions, feel free to type those questions into the chat. We'll be looking at the chat. I'll be looking at the chat, and towards the open Q&A session, I'll spend a bit of time going through some of the questions that you've asked. In terms of why this topic, it's a topic that's very dear to myself. As mentioned, my name is Stephen Gugu. I teach at Strathmore Business School. I'm also a transaction advisor, so I work very closely with the private equity funds. I also work very closely with entrepreneurs, helping them to conduct deals. At SBS, I run a program, and this is a program that I'm going to be speaking about in a second. It's called the Private Equity and Venture Capital Program, that tries to shed more light around private equity, both for entrepreneurs and for investors who may want to participate in this space. And so why this topic? The first key, a couple of points just to mention about private equity and venture capital. The first one is there's over 60 private equity and venture capital funds operating in East Africa and looking to make investments. There's in excess of 100 billion Kenya shillings of capital that private equity has allocated, focused on Kenya and East Africa, which is a lot of money, which will be used for a number of companies. My third point there is about some of the companies that have been financed using private equity and venture capital. I'm sure we've all seen this brand of Java and the kind of growth Java has been able to achieve over a period of time. And so to that extent, you can tell that this asset class finances very good businesses, and those businesses are able to grow. There's, of course, quite a number of questions that we'll get to in a second. Another bit there is that pension funds have a lot of money allocated towards this asset class. $1 billion is allocated towards this asset class, and of that, only 1% has already been invested. Chamas have $3 billion that they've made investments into, and most of that is in real estate, is in government securities and cash. So one key question that we'd want to ask is, why aren't you having more of this capital being deployed into private equity and venture capital? And that's one thing we're going to jump into in a second with David, who's a very experienced professional in this space. So the session is meant to shed some light for both entrepreneurs and for investors in terms of how to interact with this asset class. It's going to be an hour long. The main session is going to be just 50 minutes. And so I'm sure some of you are wondering, what if this is not enough for me? So if this is not enough for you, we have a special program, as I mentioned earlier, called Private Equity and Venture Capital. It's coming up between the 26th and the 30th of July, 2021. It's going to be an online program over 5 days. And so if what you hear today does not answer all the questions you have, you may want to attend this program where you'll find that most of those questions will be answered. We've structured the program in such a way that you have the first module that will be looking at talking about just what private equity and venture capital is, the mechanics behind that, how do you structure a fund and so forth. The second and the third module then speak about the process of working with private equity and venture capital, all the way from due diligence, valuation, deal structuring, value addition, and so forth. And the last module then speaks about, from an entrepreneur's perspective, how do you prepare for the entry of private equity and venture capital investors, and how do you navigate the marriage and the eventual divorce that happens when you sort of like work with private equity and venture capital. And so if you feel that the conversation today is not sufficient for you, certainly join us for this program. Be sure to contact Change. His name is not changed, but it's Change on Ciogwana at strathmore.edu. His phone number is there. We'll share these details towards the end. And so if you're interested, that's something you could most certainly do. And so just one more slide, and then I'm going to invite David, and we can jump onto the conversation that I think is going to be quite exciting. We asked for some feedback from you before you attended this session in terms of what your key concerns were. And these are some of the concerns that were raised. Some people wanted to understand what's the difference between private equity and venture capital. Am I going to lose control if I invite private equity investors into my business? Are they going to add any value? There's certainly been stories around private equity funded businesses that were not successful. Not all marriages are successful at the end of the day, but there's been those stories. So they raise some concerns. So that's a key question. Then there's people who ask about, are there any businesses that we can speak about that have been financed using private equity and venture capital? What are some of those examples? So we'll jump onto that also. At what stage does private equity or venture capital come into my business? What do I need to have accomplished as an entrepreneur? And then there was this one that I liked. Are they too exit driven? Is it all about, can we sell the business and get a return? Or are they also, focused on the entrepreneur, focused on creating value, generating value? And then there's a question around who's the best person to guide me as an entrepreneur when I'm looking for private equity or venture capital. And then lastly, I like this question: does PEVC give better financing terms compared to banks? So those are the key concerns that were there. And I think with David Owino, we should be able to answer some of these questions. David will introduce himself. Thank you for putting on your video, David. I'm going to stop sharing my screen and invite you to put on your video, David, as you have. And David, welcome. I know it's a busy day. It's 3 o'clock in the afternoon, so it can get a bit hectic. So David, if you just unmute yourself and maybe just start off by introducing yourself, just telling us, your background in terms of your experience in this sector.
Thank you, Steve. Thank you for that, for the kind introduction. Apologies, I'm trying to work with connections. Thanks be to God, you can go to 4G or go to the Wi-Fi, whichever works, you move on with it. Now I'm on my 4G on my phone, but I hope you can see me and you can hear me very well.
Yes, we can. Thank you.
Creating redundancies always works, just in case. So David Owino is my name. An alumni of Strathmore in many ways, many years ago. I always say that it's the place I learned how to be a man. Just a second. Just try and connect me on this one. Okay, sorry. So yeah, so it's a place where I learned how to be a man. I learned how to do my accounting. I learned how to do my finance. And after that, I worked as an accountant for a few years before I stumbled upon investments. I have worked my way up from being a mere junior analyst to someone who's running his own fund now in 20 years, I would say that. Could say it's quite an achievement, yeah, but it's quite an arduous journey also. So I worked in Centum for very many years, from 2001 to about 2013, rising from being an analyst to a director in charge of private equity, managing a portfolio then of about $180 million. And then I decided to join hands with a few other good friends of mine who are now my colleagues, to set up a Centric Valley Fund to basically focus now more on SME, what we would call SME investing, because we felt the space was a bit open and there's nobody doing it, and there's a bit of funds that we could then mobilize to invest in that particular space. Definition of SME, I've seen questions coming around it. We can always discuss whose definition of an SME is. Is it on quantum? Is it on number of people? Is it on turnover? And so from 2013, we'd say, until now, I've been working in the space of SME investing, especially private equity. We are now finalizing raising our fund 2 as a cent. Our first fund was $80 million invested across 3 countries in East Africa, Eastern Africa, Ethiopia, Kenya, and Uganda. And our second fund will focus on the same markets, but now include Tanzania and Rwanda as part of our ecosystem. We invest anything between $5 to $15 million per opportunity. We are private equity and not necessarily venture capital. which means we do not invest in startups. So if you have an idea, it's a very good idea, we will not invest. We actually back investments or companies with a track record. So you must have operated for a number of years, and then you must be profitable, and then now looking to move to the next level. So that's me, and I try to summarize my history as much as possible. Today, I'm actually in one of our investee companies in that area. It's called Metro Plastics. Those of you work in the construction industry will know about Metro Plastics. We produce pipes, for plumbing, pipes and fittings for plumbing. If you're sitting in a place where you have to switch on a light, most probably the electrical conduit pipe was produced by Metro Plastics. It's a 30, 40-year-old business, so it's not necessarily a very young business, but we took it over from a founder who was now retiring and wanted someone else to sort of take this journey and walk it to the next level. And for him, he didn't have the energy to do so. So we are partnering together with him to sort of try and institutionalize the business so that it survives beyond an individual. And we also take it to the next level.
Wow.
So in summary, that's what we do. And that's what I do every day. Thank you, Steve.
Thank you, David. And it's good to see that you're an investee company and you're smiling. So it means that today you didn't come to have tough conversations. Maybe things are working quite well in the company.
Not necessarily.
But David, just to pick the conversation from there, and I'm going to have this as a conversation. I won't sort of like go for the direct question and answer and so forth. So you're at Metro Plastics. One of the key questions that came up from the participants today was, are there examples of businesses that, brands that we can relate to that have received private equity and have become successful? And you're at Metro Plastics. It's not necessarily a B2C, but maybe you can relate it to us like some B2C brands that we see every day that we can be like, wow, private equity does work.
Wow, I think they are always before our eyes. If you have taken Brookside Milk, right? It had private equity money. Or if you look at it, look at the history of Brookside, Oreos invested in, that was private equity money. So that's on the food side. If you go to Java, enjoy having Java, and you think Java is a nice local brand, that has private equity money. If you bank with Equity Bank, it had private equity money. Okay, so I'm trying to give you different across different sectors, right? If you are aware of old UAP, Old Mutual, as an insurance company, it had private equity money. Okay, so those are brands that we deal, relate, and touch every day. And at some point in their ecosystem and their life cycle, they did actually have private equity money invested in them. So those are the few examples I can give you immediately off cuff. There will be very many others that we could touch on that are maybe slightly smaller, but maybe many people will not be able to relate to them. But if I just think about the big players that you have in the market, Helios is the one which backed Equity Bank when they needed capital to show up their core capital to be able to then expand rapidly. UAP had like 4 or 5 rounds of private equity money coming in back from the year 2000 or the year to 2012, I think. If I even stretch it a little bit further, if you allow me to call Centum a private equity company, if you drink a Coke, and then Centum is an investor in the bottling company. In fact, it was invested in almost all the bottling companies except the one in Kisumu and the one in Mombasa. If you drink alcohol, then Kenya Wine Agencies was one of those investments that Centum had done back then. If you like Isuzu trucks and you take the matatus every day, those Isuzu trucks, Centum was an investor in General Motors, or what we call Isuzu East Africa. So the list can go on and on and on and on and on. Yeah. There's good news and there's always bad news. There's some things that works, some things that don't work. Of course.
In fact, I was just going to ask you that, David. You've given us all the brands that we relate to. Are there any brands? I don't know that you're allowed to say this. Are there any brands that got private equity and that was their deathbed, so to say?
I will lift my head and say I know of none. I know of none. But I know there are many what you call war room stories. And people tend to then point at the private equity money, and there have been many media stories. And I have tried investigating, sort of going back into the ecosystem and asking the guys, look, what happened here? More often than not, it is I would not say it's private equity to blame. It is a question of lack of understanding and maybe promises being made by both parties Okay, private equity, to be honest with you, is 100% like marriage. Okay, it's not about just taking. It's you actually give commitments, and when you get the money, you as an entrepreneur also give commitments to the other party. And more often than not, you will find that maybe PE oversells and says, okay, look, we know we are here to support you. We are going to grow the business. We won't run the business. We think you're running it very well, and blah blah blah. And then the entrepreneur gets the feeling that I will continue operating as I have been operating before. Okay, I'll continue running. It doesn't happen that way. You will not continue operating like you're operating before. So if you got that impression when PE was coming in, that's a wrong impression. And if that's what they sold to you, that's a lie. Okay, it doesn't work like that. No. When PE comes in, things will change, and change in a big way, especially on the decision-making front. Whereas you are an entrepreneur, you decide, let me try to do this thing. Let me try this investment here. Okay, with PE money, you cannot make that decision at the SPA. Because you'll have to call for a board meeting, you'll have to sit down, you'll have to build a business case, you'll have to discuss that. And the entrepreneur will tell you, look, I'm wasting time. Let's just do this thing. My gut tells me it's the right thing. And maybe it's right. But once you bring an institutional investor in your business, that decision-making process stops completely. And now you need to switch on to a more formalized way of doing things. The ones that have not done well also, I think will primarily fall on governance. Okay. So that one, I would say, yes, I blame the PE. The PE company or the PE fund should be able to evaluate and figure out the readiness of the investee company. It's a tough thing to do because there are some businesses that are actually very big. Okay, if you look at the revenue, the number of employees, the assets, they hold very big, but they still make decisions on the spur of the moment of the founder. The founder just says this, and people do it, and somehow it's like magic, it works. Yeah. But then PE comes in and they tell him, no, you cannot do that. You need to have a board meeting, governance structures, you have a finance committee, you have an audit committee. And if you want to continue running the business, you are now going to be an employee of the business. It's not like it's mine, the business is me and I'm the business. No, there'll be a separation of the individual, of the ownership and the entity. And that, I would call it that division, creating that clarity creates a lot of problems, and that's normally the beginning of the failures you see. The beginnings of failures is where normally the entrepreneur is told, now you are answerable and the business can fire you. I mean, Apple actually, you are told Steve Jobs was fired when he got this, and the VC and the angel investors to his business as Apple back then, they fired him because perhaps the sense they could work with him, and then they had to bring him back. Hopefully he had learned his lessons and he knew now how this is how I'll work with these guys. So yeah, it's a very, there are people who would say, you'd point fingers and say, that didn't work and that didn't work and that didn't work, or Kraft Silicon, or I don't know who, or those news about this pharmacy chain or whatever it is. But when you go back and figure out exactly what went wrong, it is the chemistry, and more often than not, it's related to governance of the business itself, and that's where it goes wrong, yes. But I'll not lift up my hand and say, that company failed, and this other one failed. No, I will not do that. Yes.
Okay. No, thanks. And there's so many ways we could take this conversation, but I want to maybe step back a bit. There's one question that was asked, which was around what's the difference between private equity and venture capital? So that we're very clear in terms of how we're using the terms so that nobody's confused.
Actually, to be honest, when you think about it seriously, these terms can be used interchangeably, venture capital and private equity. But venture capital has been more used to describe what I would call small entities, or what you call early stage investing. So when you hear venture capital, people tend to think that refers to more early stage. So Ascent is not a venture capital firm. Like I told you, we invest in businesses with track record. You have a history, you performed well, you have a track record of customers. Whereas venture capital will be investing, let me use examples. Investing in Twiga Foods, that's a venture capital investment, right? It's a pretty new entity. It's trying to create its own space. Whether it's new or already an existing space, it's not profitable, but it's capturing a big market share. PE generally will be investing in more profitable, more already grounded businesses, whereas venture capital will be focusing more on sort of startups, and as we call them, early ventures. Okay, things that are trying to create their own space in the market. That will be the nuance you have. And venture capital will be more smaller ticket sizes. So if you use Africa as an example, you'd say anything between $100,000 or 10 million shillings to 1.5 million shillings or 150 million shillings. Let me use shillings, not dollars. Sorry, we in our parlance use a lot of dollars a lot of the time. So 150 million shillings to 200 million shillings. That will be seen more as what we call venture capital investment. But anything starting going above that and investing in companies more, 5 years experience or 10 years, it's been in the market, it's covered its own niche, that will be more referred to as a private equity investment.
Yeah. Okay.
Yeah.
Thank you. And at least now we have that clear there in terms of terminology. So I'm going to move us now forward. So you are speaking about control and the fact that now all of a sudden you've come in. I was God in the company, but now I'm demoted. I have to be an employee in the company. I can't make roadside decisions or kitchen place decisions anymore, and so forth.
Yes.
But what do I get in return then by giving away all this control? What do I get?
Well, what were you looking for? That's the question. When you
I wanted money only. I was comparing you with a bank, but you came in with so many other things.
Well, yeah, money with strings attached, right?
Yeah.
So I will put it this way, Steve. At the end of the day, there would be those people who are saying, I'm raising capital for growth. I'm looking for money for growth. And I think the best funds I need for growth will be private equity. Someone who shares with me the risks and returns that come with it, okay? So they are an owner like me in this business. So we are partners in this business. Or it could be that you are running a very good business. It's very nice. And then someone comes and knocks and says, oh, hey, you think you like your business, think you're doing a great job, we want to be partners with you. So can we come in and we give you some bit of equity, you get a bit of money out, you've done so well, you need to take some money and go for holiday or do that hobby of yours you do on the side, or diversify. Diversify yourself. So that's PE coming knocking your door. You are not looking for them, they came knocking your door because they think you're running an attractive business and they can generate a return. The key trick to know is that when PE comes in, the money that's coming in is money looking for a return. Okay? Who is the customer of a private equity fund or a private equity company? There must be a clear distinction. The customer of a private equity company is not the investee. The customer of a private equity company is the investor, the fellow I got the money from. Because I told him, you give me your money, I'll give you a return. Okay? By doing what? By looking for companies that I can buy and sell. A friend of mine who's an actuary told me, look, you PE guys, you're not different from Mama Mboga, for example. The same way Mama Mboga sells mangoes or sells sukuma wiki there, is the same way. We go and look at a company, we tell them, like, this company of yours, yeah, we want to buy some mangoes here. You hold this mango is not good, it has this thing there, the other thing there, you negotiate and agree on a price and eventually buy the mango. Same thing, we buy and sell companies. The business of private equities, we buy and sell companies. That's what we do. Now, the return you get as the person who's bringing in private equity into your business is, number one, you are able to get value if it's a buyout. People say your company is worth 10 billion shillings. Well, value is what it is. It's all in the mind, right? How do you realize that value? You can only realize that value by selling and realizing a bit of that cash. So that could be a return that you get, that my company is valued at 1 billion shillings. Let these PE guys come and I give them 30%. I'm able to get out 300 million shillings and put it in my pocket. And I still own 70% of that whole thing. So you're able to realize your investment, right? Nobody does business for fun. People do a business for a return, okay? So that's one. Or two, you are growing. You need money to grow. You need to invest in things to grow your business. And you need money. So PE comes in, believes in your story and your strategy, and then gives you money to be able to then get that growth. You have a bigger company now. That's another return that you get. Or three, you are sunk beyond your head debt. You borrowed money, the banks convinced you, don't talk to PE. Then they'll come and take shares in your business. For us, we just lend you money and then you own 100% of the business. And then you realize, okay, I own, but I'm working for them. All the money I'm making is going to the bank. Basically, they're not sharing with me in a what do you call it? In a correlated way, the returns, the rewards and return. Whether you make money or not, the bank will want their money back plus their interest. Whereas private equity, if years are tough, then there's nobody who's getting anything. If years are good, then we get some dividend out, right? So we run the roller coaster with you. So you must be properly motivated. By the way, there are some people who actually bring in PE, not because of those 3 reasons I've given, but for the reasons of they want their business to be a sustainable institutions that live beyond them. Those are the ones I like, because the business cannot be me and me and the business, and if I'm not there, then the business dies. So you're bringing in PE to help you institutionalize your business such a way that beyond you, whether you have 1 share or not, you have that brand existing over the years and over the ages, right? So whether you have shares there or not, PE comes in to create this governance framework that separates owners from the business and then allows you to sort of say, the thing I created, the company I created, the baby I created has now grown up and it's beyond me, whether I own a share or not. You are proud to be associated with it. Private equity can help you also do that,
And I like those points, right? Right from the cash, from helping you with your growth ambitions, sustainability, and I like the point of sustainability quite a bit. How would you then? Because private equity is looking. We said you compare it to a marriage at the beginning, but then it's a marriage which has a divorce, so to say, at the end, right?
Yes.
So if someone is asking, okay, so you're saying that the sustainability, how does that exactly work? If you're telling me about exit and we need to realize value and so forth, but I'm building a family business. How does that work?
There are 2 things. You're right, Steve, in the sense that we enter into this union with an agreement that will come to an end at some point. And the argument will be the long-term elements of it, And to be honest with you, in Africa, there's a big debate that's going on. I am one of those proponents that this cookie cutter idea of private equity, the way it works in America or in the West, will work in Africa. I think it needs to be tweaked in Africa. But yes, we do come in with our eyes to the door. It's like we walk backwards. You say, I'm coming in, but where's the exit door? Because at one point, I'll need to get out of here. 2 things that goes with it. And that's why whoever is getting private equity money into their business has to be very clear. And I always tell people, even the investments I do in Metroplastics, I told Mr. Shah, you need to get advice. You must get independent professional advice. To be honest, I'm even selective, and I tell them, don't get any lawyer. Please get a lawyer who is a commercial lawyer who has done transactions. Then when they read the term sheet or when they read the shareholders agreement, they will be able to explain to you exactly what that means. Because in the family business, we never had a shareholders agreement. You see, or there's an addendum attached to the shareholders agreement that says you'll do so many things. Many people, when they're getting the money, they don't read. They always say, I have experienced it and I continue experiencing it and I will continue experiencing it. When the entrepreneur tells you, I understand. I'm happy. I want to bring you guys in to help me. 1 year later, it always changes. It almost always changes. And the fellow is like, I regret getting you guys into my business. That's a constant line I hear, especially after the first 6 months or the first 1 year. I always get that feeling of a tinge of regret from the entrepreneur. Why? Because of change. Nobody likes change. Nobody likes change. But we normally make it very clear that we will not invest in a business if we do not understand how we are going to get out. So even as we negotiate to go in, we tell him we will have to sell. We will have to sell, and we might sell to a third party. Now, what about me and my family business? Yeah, you'll have the option maybe to say, look, if you get a buyer who's offering you 2x your money and I can match it, I'm happy, because then it means I get my money back faster. No due diligence, no strings attached in agreements, reps, and warranties. So there have been cases where owners are given fast right of refusal to buy back the business from the private equity company, or the owners are actually given the right to sell along, or what you call tag along, with the private equity fund that is selling at the same time, or then just be happy to work with the next party who is coming in to work together with them, hopefully for the longer term as compared to private equity, a private equity fund. But yes, it's normally a very tough one, and there are those who do minority deals and have that issue, because then they will come with a drag along. So you find someone is investing in a business and they're taking 30%, and they're telling you, when I'm going to be selling in 6 years' time, I will sell 60% of the business, which means you in your business, you're a majority today, you'll become a minority at the end of the 6 years. There's a danger of you becoming a minority and someone else now running the show. You see, not that the private equity will take your shares and take the money. They will sell you 30%, you will take the money. Then they'll take their 30%, you will take your 30%. Okay? That's why it's good to know what you're getting into. It's very important to get very good advice and mentally prepare yourself for this potential eventuality. Because there are companies where I have seen families have been happy with succession of one PE fund, sold to another PE fund, sold to another, what do you call it, a strategic, for example, and they are happy with it. Or they actually did sell together with the private equity fund and realized their investments and took the money to do other things with it, and diversified away. And I've seen others who have actually bought out and said, okay, look, we will actually buy out the private equity company and continue keeping our company to ourselves. It's tough. Remember, a huge chunk of the return for private equity doesn't come from the company itself. The company will usually not be able to afford to pay back the private equity company their return. That return is...
Sorry, I think we've lost David for a second there.
Okay, sorry, yeah. So a majority of the companies will be, of the return that the private equity company gets is given by the person who's buying their stake. Someone from without who's looking in and saying, you have a very good asset here, I'm going to pay you 2 times the money you invested in. Okay, it's not money coming from the business. It's just the business has done very well that someone is ready to pay an alpha for the performance it has done. To expect the business to pay the PE fund the return they have through dividends and everything is normally very tough. It participates, but I would always say that maybe 30% of the return, max 30-35% of the return will come from the company. 70% of the return will come from the profit from the sale they make.
Okay. Thanks for that. You know, just good to know that I guess as an entrepreneur, you need to be ready when you're inviting private equity for that exit discussion, either to buy them out or indeed to, you know, to sell a bit of the stake in the business at that point. Now, there's a couple of things that you've mentioned that I just want to maybe just highlight. But before that, if you have any questions, please type them on the chat. I'm going to be coming to the chat after this question. So please type any questions you have. I know there's already some questions that have already been shared, but just in case there's something that comes out of that. And so, David, I want you to just speak a bit about what happens when things go wrong. You know, I mean, it's a huge concern in the market in Kenya, and I guess even internationally. It's not all deals, and I think you mentioned some of the deals out there that have not gone right, and some of the reasons why. But I want you to just speak about how is that process? How do you then decide? How do you go around resolving issues, and how does someone, you know, either as an entrepreneur or as an investor, ensure they avoid some of the pitfalls that bring issues when private equity has come into a business?
Yeah, I mean, it's normally very tough to predict what will go wrong. I will tell you in my experience, in our current portfolio, we've had issues out of 9 companies, we've had issues in 4. Okay, so it's like I said, presumably you have things going wrong. Now, we as PE players always anticipate that things can go wrong. Okay, and that's the reason why in the first place we try and extricate the business as we're investing, as we're going in, to extricate the business from the ownership. Okay, there'll be two distinct entities. The first thing you'll normally hear is that the entrepreneur will, if he was running the business, for instance, the first thing will happen is that potentially he'll be told to step aside. Okay, yeah, you please, now maybe we need to get someone else to look at this thing. In the agreements that we sign with the partners we go in, they are normally very extensive, very, very extensive. Imagine a normal company. In a normal company, you have what you call the memorandum and articles of association, okay, which define how you will govern the business, how you will manage the business, appointment of directors, roles of directors, what the business can do, what it cannot do, is governed by the memorandums and articles of association. In private equity, you have to call a shareholders agreement. That thing is very thick. No, members, if you look at the general one from the Companies Act, maybe how many pages? 30 pages. A shareholders agreement in the PE will be maybe 150 pages. It tries to figure out what could go wrong and how we resolve whatever could go wrong. And invariably, for every 10 deals we do, we always say 2 will do very well, 2 will do extremely well, 3 or 4 will maybe give you back your money if you're lucky, and another 3 will burn. Okay, so laws of probability, 30% of your portfolio will not give you the return you expect. In fact, you expect to lose all your money as a private equity fund. Again, it goes back to partnership. It goes back to the relationship you have with the entrepreneur. Yeah. Sometimes I have seen situations where we've decided from the onset that we are going to invest in this business, but the entrepreneur cannot run the business, cannot continue being the one running the business. Because if he continues running the business, we can see conflict in year 1, year 2, year 3, clearly, where we should be clever enough to do that. If you don't do that, then conflict will come. And at that particular point in time, conflict doesn't come when things are going well. The revenues are going up and there'll be no conflict.
Yeah.
Conflict will come when you are investing, and we said we expect the company to grow at 10% per annum. Now we are losing sales, we are losing market share, and pretty fast. And something must be done. Something must change. Okay. And the entrepreneur will always feel like I am the best agent to change this thing. And the private equity fund will say, no, can't do. You will continue doing things the same way you've been saying you'll do them. And it's difficult to change. So we need you to step aside and get someone else to run this business. Very few instances you will find entrepreneurs agreeing to say, maybe I'm the one who should go and step aside and let someone else come and take over these reins and run with it. Very, very few times. And that then creates conflict. But I can assure you, it's all governed in the shareholders agreement, how you will deal with these things. Conflict will always arise when an entrepreneur makes a decision. I'll give you a simple example. This I've come across many times. Entrepreneur decides that the CFO is not working very well, and he decides to fire the CFO. Okay, says, okay, look, this finance director is inept. He's not doing things the way I want him to do. So I think I agree with him to leave. Let him leave tomorrow. He has not called a board meeting. He has not informed his partners who are not running the business on a day-to-day. So now, the next board meeting, you come, and he tells you, I reached an agreement with the finance director for him to leave. I don't think it was working. Like, wait a minute. First of all, you've breached the shareholders agreement we had initially. You cannot make that decision. He used to make that decision before, but he cannot make that decision now. Even if the entrepreneur is inept. I mean, the finance director is inept, okay? You have to call for a board meeting, discuss the conduct, and for him, you're completely wasting time. You do these things chap. You move on to the next step. Yeah, I'll give you another example where, so one of our partners, companies, this is a good example, where he doesn't like employees who do wrong things. He fires them on the spot. But we bring in what we call environmental, social, and governance. Human beings must be treated in a fair way according to the law. You must follow Employment Act. But this fellow has stolen from me. I need to fire him. He's a thief. Bad influencer. Like, it doesn't matter. You must follow the law. And the entrepreneur is almost pulling his hair apart. So now you're going to sit down with a thief, and then tell him, yeah, you have to. That's how you're going to run this business going forward. And they find it very tough. But I'll just put it simple: change. Change is something that people assume is going to be easy. It's not going to be easy. If you've been running your business for 20 years in a particular way, and you bring in a partner to become a co-owner, then it simply means that you have to change. I have one successful company in Uganda where the entrepreneur, we explain to them what we will do, okay, when we come in. And they are the ones who made the decision. I said, look, then it means I cannot continue being the CEO of this business. We have to look for an independent person to manage this business so that I can sit on the same side as you private equity guys to question that person, because I cannot stand being questioned by people, and nobody has questioned me for the last 20 years. So who are you to come and start questioning me? So together with it was a lady, and I think that's the woman intuition, the sixth sense or the seventh sense of the woman. She figured, no, there'll be conflict coming in. So I'd rather sit with David on this other side, and we recruit someone
and then we give the person the mandate to run the business. If they don't perform well, we look for someone else. And that has worked very well for us.
Wow. I'm still looking. I mean, you raised so many issues that I think I hope we had enough time to go through them. And I still insist for the people who sort of like are picking up questions here and they're like, I'd like to learn more about that. Please make sure to come for the program that you're speaking about that is running a bit later. I'll speak about that in a sec. David, just to continue then, and I want to, we've gone very micro and we've spent quite a bit of time on the company, the relationship and so forth. I want to sort of like come back to the macro picture just for a second. The key question we were asking for this program was, what is the role of private equity, venture capital in spurring the SME sector, the growth in the SME sector? So direct question to you. Do you think private equity, venture capital has worked in East Africa? Has it contributed to the kind of growth that maybe we see when you look at other regions like the US, the more developed economies where, private equity and venture capital has been there for quite a bit of time?
I think it's a mixed bag, if you ask me. I have seen it work very well in the, what I would call larger institutions. I mean, Java would not have grown to the extent it has grown today if it didn't have the private equity money injecting money and bringing all these governance structures to become the biggest sort of retail chain when it comes to restaurant, yeah? And I love it because it's one of those we can showcase as a success from East Africa, East Africa brand. I would also mention Equity Bank. Equity Bank, yes, it was growing pretty fast, but having that backing from Helios that would then make them go aggressively after the micro savers and MFIs, the small little businesses, the Mamambogas who want to look for a bank that can work for them. It was on the back of very strong core capital base that was supported by PE. So when I look at those and evaluate those, I can see it has worked. The likes of UAP, the likes of Brookside, I think it has worked. Where it has struggled a little bit is on the SME front, on the small and medium-sized enterprises front. It has struggled a little bit. And the question would be, why is it struggling at that particular level? And maybe that's where it's the most. And my question would be investor readiness. There is some sort of a mismatch. Whether the entrepreneur or the family business are really ready for private equity money to come in. I think that jury is still out there. I'm hoping we can be able to showcase 2 or 3 successful investments that or companies that have brought in private equity funding and that has made them survive. I think one of the businesses that we've invested in called Auto Springs has actually gone through very tough times over this COVID period. But the mere fact that they had an institutional investor who is not ready to lose their money and who's ready to back it up because they know this is on a short term, gave a lot of, what I would call it, courage and confidence, even in amongst the employees. They knew that we have an institution behind us here that cannot let us fail. And we have follow-on investment. Basically, look, do we need to pump in money? And if we need to pump in money to ensure that we can survive this wave, we are able to survive this wave. That gave the company confidence and the management team their confidence that, look, we have got guys who back us up who will not allow us to fail, okay? Because they have got that pot of capital that can make us survive. It's really, really, really helpful. Number 2, I think it has worked in the sense that some of those SMEs we as a center have invested in have had, what I would call it, easy conversations with the banks. I've gone to SMEs where we invested and the banks who are lending the money basically were asking for personal guarantees. I don't know if you know what that means, Steve. Basically, I'm giving a personal guarantee that if things go wrong, you can come and take my sufuria at home. Forget about taking the business. You can take my kids' shoes for going to school because I've given a whole personal guarantee for the loans you've taken. Where we invest, as a private equity company, we tell the banks, you have to remove the personal guarantees for directors, okay? And if it's difficult for you to do that, we look for another bank to work with. Because I will not sit in a boardroom where my partner on the other side has given personal guarantees of his children's shoes, his beddings, his utensils, basically everything that he has, his house. And me, as an institutional investor, I'm like, I don't give, you can't touch me. Me, there's a wall here. We must be the same. If you're directors, you're directors. So we've gone in and told the banks, we are an institution and we are sitting on the board of that company and this cannot hold. This cannot be the case. And it has helped. Yeah, I remember one of my partners, same partner, I'm telling you, you'd walk into the bank and tell them, you have to remove this personal guarantee. They say no. And I tell them, if you can't, no, we will remove our banking relationship elsewhere. Wait. Okay, now we can arrange. No, you have to remove it. And they removed it. And the fellow looks like, now I walk freely. I feel liberated.
Yeah.
So you will not necessarily read those in the media or anything, but they're there. They're actually there. And some of the small SMEs that will say, why aren't you seeing them working? Maybe they're surviving because they have, like I said, they have that institutional backing behind them. They might be struggling, but they're surviving over time, and hopefully they weather the storm. Because the PE investor doesn't want to lose their money also.
Okay. Wow. I like that. And I like that story about the personal guarantees, because I know I've sat in boards representing private equity funds, and every so often the entrepreneur says, "Have you given any personal guarantee you when you're saying we should do ABCD?" So it's really good that private equity then brings everybody whole, so to say, so that you're sitting on the same side. There's one question which has come up, which is related to this aspect of corporate governance that we spoke about earlier. So Steven says, succession planning in Kenya is challenging. How will we challenge the scarcity mindset and move this more into a more abundance mindset? This seems to challenge big time. Any suggestion for family-run businesses as regards professionalism? I don't know if it was the question. I think there's an element of how do you become more professional as a family business. Then there's a question around how do you get family businesses to think a bit more broadly and not to have a scarcity mindset where they feel as though as a private equity investor, you're coming to, eat the small pie they've cooked rather than, expand the pie. How do you sort of like manage those two elements? And I think this is going to be probably our last question before I ask you for closing remarks.
Yeah, the two things. One, I said earlier, there's a problem of separating the business from the ownership. That's the biggest issue. I always ask business owners, the question is, if you are not there, what would happen to your business? If one was to tell me, look, if I'm not there, this business fails, then they are failed as an entrepreneur. I tell them, you've set yourself for failure, okay? You should be successful when, even if you own 0 shares in that business, the brand continues, it supersedes you as an individual. And I use the examples of Microsoft and I don't know who, Google, and tell them, you think Bill Gates owns 90% of Microsoft? Nah. He's a small little shareholder and he's not there anymore. He's doing his own things with Melinda Gates Foundation and the business is running. That's ultimate success for business. Now, changing that mentality is very tough, okay? I think it requires businesses to move beyond their ownership mindset. And when they're succeeding, maybe it's moving now from one family member to the next generation. That generation then must create a cohort of what you call strong base. The first thing to do is to create a board of directors or a board of advisors. People who are not afraid of you and who will tell you this is a wrong decision you're making. Whether you continue with that path or not, it's a wrong decision you're making. Okay, almost like mentoring you to sort of feeling like you can also hear critiques. Are you open to being critiqued on your decisions? If you're not open to being critiqued, then chances are high that your business dies with you. But the mindset must change that first of all, this business of mine is like my baby, and your children will not stay in your house forever. Once they grow up, they move out.
Yeah.
The same thing that should happen within your business. You think that once the business grows, at some point, it will be beyond me, and I have to leave it to the professionals to run it. And best way to prepare yourself for this is then to bring in outsiders who can tell you the truth. And that's the reason why you have a board of directors. And that's why you need to have independent directors who will sit down and tell you, look, what you're doing here is not cool. And as a board, we have the right to say no to it. And there's nothing you can do. And you feel completely frustrated, but then you live with that fact and you live to fight another day. Then you find yourself being ready now to move your business to the next level. Yeah. And yes, it's challenging, but if you cannot overcome that, chances are high that the business then dies. You find the founder is not there and everything starts crumbling down. I mean, to be honest with you, this one is public. We see what's happening in Tuskys. It's very sad. I mean, it shouldn't happen that way. But probably had they had an institutional investor in that business, things would have been a little bit different. And immediately that happened, I saw many supermarkets getting PE money.
Yeah.
I can assure you those supermarkets have made a wise decision because their governance structures will change. It cannot remain the same. They'll change and hopefully for make them more sustainable.
Thanks. And, I think the supermarket sector, if you want to call it that, or space, has really seen it tough, right? Right from Nakumat, Uchumi, Taskis. So I'm really hoping that we don't lose any more local brands, because at some point to the local brands and now the international brands have come in. So we need to stop. We need to stop. We can continue this conversation. It seems like we just started a moment ago and now we already have to close. So I'm just going to ask you for closing remarks from your end before I make my own closing remarks, and then sort of like try to wrap up the conversation. So David.
So I don't know what to say. I think I've spoken a lot, Steve. It should have been a 2-hour or 3-hour webinar or sort. But the thing is this, my message to anybody who's in the SME sector or who's advising the SME sector and is considering private equity investment, my advice is only two. Number one, first of all, consider that in your mindset, you're ready for change, because it will come, and it will come in a big way. Not small, big way. And number two, if you're considering that investment, please take good advice. And take your time before making the decision to go the private equity route, because the war stories are there, but the successful stories are there. And I guess the successful stories are there because they were prepared. They had a mentality that was prepared for this particular thing. And number three, PE, remember, you could say they are bad, they've come in and everything, but they are putting the money. These fellows came in and you told them the value of the business is $1 million. They put another $1 million, so they got 50% of the business. So the pie became bigger, it became $2 million. They have rights to also ask and question, how the business is being run. Usually they get the short end of the stick because, when Steve was running the business, we knew Steve and Steve was the business. No, the business is separate from Steve. And PE is trying to come in to sort of create that sense of institutionalizing the business. So let's not with PE, let's look at the success stories and ask ourselves what made them successful, what was the mindset of that entrepreneur, and how can we then bring that into such a conversation. And someone has actually asked the question, it would have been very nice to get an entrepreneur who has gotten PE money to come and say, this is what David has done to me. Thank you, Steve.
Thank you very much, David. We can't overthank you. For the person who asked that question, who wanted to see the other side, if you come for the program that we are proposing or that's coming up, you will definitely get to hear from entrepreneurs who've gone through private equity and sort of like have their own stories to share around what has happened. David, just some sound bites from what you've mentioned, which I think are just important just for us to think about. I like the whole idea about be ready for change, because it's going to come. I like the idea that, which is important, that you're going to lose a bit of control, but that's not the whole picture, right? Because there's so many brands that we've seen that, yes, they've lost that control as entrepreneurs, but they've been able to gain much more. If you look at the brands now, they're sustainable. They've been there for a number of years. They have a lot of impact. They've created a lot of money, not only just for the entrepreneurs, but also for the investors in this case. So I also like that element. There's several other things we could have explored. Unfortunately, we can't explore today. People have to come for the program. So David, thank you very much. In other webinars I've been on, people have been asked to clap virtually. If that is possible, please do that. But allow me just to wrap up the session because I want to ensure that we finish the next 2 minutes. I've shared my screen once again. So just to reiterate, the program I've been talking about is happening between the 26th to the 30th of July. If you're interested in that program, please write to Change. This is not Change, it's Change. That's his email right there. And you'll get an email out of this. And that's the phone number you can contact if you're interested with the program. Thank you very much. And we look forward, of course, to having you at SBS for any other programs that we have. And indeed for the subsequent webinars that we'll be hosting. So do have a nice rest of the afternoon or evening. And kwaherini sana. Thank you.